Welcome back to the 90s podcast hosted by yours truly, Kevin Thompson, founder and CEO of 99 Capital Group. Thank you guys for joining me. As I always say, subscribe to the channel. As I always say, go and get this book, MLB to CFP, live on Apple and Amazon. You have any questions, comments, or concerns, you can email us at info@99capitalgroup.com. Send us your questions. Go to the website at www.99capitalgroup.com. Schedule your appointment. As you know, we're here to do what? Educate, empower, engage, and also entertain. Follow us on all social media channels at 99cap or at MLB to CFP. Follow us also on our Now What Substack, where we have a nice, wonderful blog about finance. It's a wonderful, wonderful thing to follow. So thank you guys for listening. Today we're talking about the 5 key areas I want all retirees to focus on heading into 2026. This is for the retiree. Let's get it. So here in the 90s podcast, we often talk about a bunch of things in the broad area of finance, but I often have conversations around the retirees because the majority of my clients are in the retiree world. They're 60 and older, getting ready to take Social Security and things like that. So this one particular thing, which is the Enhanced Senior Deduction, I think is quite honestly one of the most powerful things for many of my retirees. So let's start with that. The Enhanced Senior Deduction from the 03B or the One Big Beautiful Bill Act. If you're 65 or older, you can claim an additional $6,000 of deduction. If you're married filing jointly with spouses both qualifying over 65, that's another $12,000 you can qualify. So this is in addition to your normal standard deduction and available if you don't itemize. So this deduction begins to phase out once your modified adjusted gross income exceeds $75,000 for single or $150,000 married filing jointly. So why does this matter? It can dramatically reduce your taxable income during a period where tax rates and brackets can be more volatile as we move past 2025. So planning your income events around this deduction can save you thousands. I think this is quite honestly one of the most powerful things for many retirees. Some of you may be looking to do Roth conversions or do other things to keep your modified adjusted gross income down. This right here, I believe, in a nutshell, allows you to do a lot of things, especially with Roth conversions, because they are actually giving you money back. Think about it this way. If you have $1 that you put away in a tax-deferred vehicle, and they're giving you a portion of that dollar back right now in regards to more deductibility, why not take it? It's just a carrot, I believe, that it should be taken at this present juncture. But again, talk to your financial advisor to see if it's in your best interest. But in my humble opinion, if they're giving you a carrot, you might as well eat it. And this is a great opportunity to use this carrot to benefit you on down the line. So we talked about the enhanced deduction. I think it's powerful. Now let's talk about above the line car loan interest deduction. This is something that's not often quite talked about because, again, this is something that happens even if you don't itemize. Here is one of the game changers for retirees buying a vehicle, especially those that are looking to buy a new vehicle right now. You can deduct up to $10,000 a year of interest on new auto loans above the line, meaning you don't have to itemize to take it. Again, you don't have to itemize to take it. This is something that you usually would have to itemize to basically take it. And of course, with all the deductions moving higher, with enhanced deductions, the enhanced senior credits, and all the other stuff that you get, it was very difficult to itemize. But this is something that you can do without having to itemize. This applies to new passenger vehicles only, purchased for personal use from 2025 to 2028 with loans originated before December 31st of 2024. Not leases or used cars, only new vehicles. This deduction phases out for single filers making above $100,000 of modified adjusted gross income and joint filers making over $200,000 of modified adjusted gross income, and it's eliminated entirely at higher income thresholds. Because this reduces your AGI before your standard deduction, this benefit is available even if you never itemize. Rare in today's retirement tax landscape, this is another powerful, quite overlooked thing. I had this conversation just today about this, matter of fact, and this is a beautiful, beautiful thing that many of you may be looking to do. So this may be an opportunity to purchase that new car. And again, this is something that they're using to juice the economy just a bit, but this gives you the opportunity to go out, buy that new car, take take some of that interest off of your modified adjusted gross income and reduce your taxable income if there is the ability to do so. So we've talked about enhanced senior deduction. We talked about the interest deduction there, the increased standard deduction, and stacking with the seniors. Now, if you combine that your base standard deduction for tax year 2026, the standard deduction is roughly $16,100 for singles and $32,200 for married couples filing jointly. Add in your age 65 additional standard deduction on top of that, plus the enhanced standard deduction we just discussed, and many retirees can shelter a very large chunk of their income, potentially well over $45,000 a year, before hitting taxable income. Yes, before hitting taxable income. But don't forget strategy, because so many retirees will take the standard deduction. You may need to bunch itemizable items like charitable gifts until 1 year, or use qualified charitable distributions or QCDs from your IRAs to keep taxable income low. This is where the rubber meets the road when you're talking to your financial advisor. How to maximize your deductions, maximize the amount of money that can come out of your IRAs without having a taxable consequence. And also not going into these different levels of what we're going to talk about in a second, which is IRMAA and increasing your Medicare tax. There is a right way to do this, and if you get it wrong, it could cost you thousands of dollars. So we've talked about deductions, whether it be the enhanced deduction, stacking other deductions in regards to the enhanced, in regards to the interest. Now we're talking about number 4, which is Medicare premiums and IRMAA. Healthcare costs continue rising. For 2026, the Medicare Part B premium is $202.90 per month, up from $185 in 2025. And the Part B deductible is $283. But here's the part that really hits your wallet. I had this conversation with Paul Morrison recently. IRMAA, the income-related monthly adjustment amount. If your modified adjusted gross income from your 2024 return is above a certain threshold, you pay higher Medicare premiums on top of the base Part B amount. So what we talked about was getting SSA 44, making sure that you put that in there, because if you had a significant event, whether a job loss or something like that, you need to have that in place so they know that, okay, we won't increase your premiums because of such event. So talk to your financial advisor, making sure that you have that done, especially if you're looking to retire. If you're looking to retire, make sure you have that document in the system so they don't necessarily raise your premiums in a year or two. And again, for 2026, IRMAA kicks in $109,000 single, $218,000 joint, and increases premiums in tiers. Total Part B with the highest IRMAA can be as much as $689.90 per month. So even if a Roth conversion, large RA distribution or capital gain can bump you into new IRMAA tiers, planning income timing matters more than ever. A lot of people think that, I can just take capital gains and never pay tax on them. Well, that may be the case on the capital gain. But what also increases is your Social Security taxation, and it also bumps you up into different IRMAA tiers. So just because you don't pay taxes on one thing doesn't mean you don't pay taxes somewhere else. So it's important, again, to talk to your financial advisor and or your CPA to make sure that you're not necessarily putting yourself in a situation where you're paying taxes in other places just to avoid taxes in one. So we talked about IRMAA, we talked about the enhanced deduction, we talked about stacking deductions, we talked about the new car benefit there. One thing that we don't often talk about, I know it's kind of boring, but it's very complicated, is open enrollment and why you might want to switch from Medicare Advantage. Right? You're seeing all the commercials. You see Joe Namath come on TV. You're saying, maybe I should go to Medicare Advantage. Well, yes and no. It depends on your health and all the other things. Yes, Medicare Advantage may seem like it's cheaper, but we've seen time and time again where you go to a hospital, you go to your doctor may be in the network, but the hospital may be out of network, and you get hit with all of these consequences, whether it be these costs and these fees. We don't want to put you in a situation where you're getting hit with out-of-pocket expenses that you did not expect. We want to make life easy when we get to retirement. We don't want to have to deal with all of these different things. This is an alphabet soup. I get it. Part A, Part B, Part C, Part D, Medigap, Plan G, Plan F, whatever it could be. There's a lot of alphabet soup, and that's why it's important to get with a Medicare specialist on your behalf to make the right decision. So Again, each year from October 15th to December 7th, you can change your Medicare coverage. Many retirees often who originally picked Medicare Advantage because it looks inexpensive and includes extras. But in 2026, this trend is seen narrowing networks, greater utilization controls, and unpredictable out-of-pocket network costs, like I just mentioned, especially if you travel or change providers. What I'm seeing in this current landscape is that a lot of doctors may just fall out of network. They say, you know what, it's no longer conducive for us to run a business. I heard a story about a person that no longer took a certain Medicare because of or Medicare Advantage because of reimbursements being so low. So you can have a doctor for 30 years, but they can just, you know what, we're no longer going to do this. We're going to go to take on traditional Medicare or what have you. And now you don't have your doctor you had for 30 years. So it's important to understand how these things may impact you. Again, original Medicare with the Medigap policy, which is supplemental insurance, gives more flexibility with providers nationwide, but you may need to undergo medical underwriting depending on the state and the timing on when you get it. And that's why it's important when we're having these discussions. If you got to go through medical underwriting, it may even be more expensive for you, but again, it may be better. Even though the price of Medicare Advantage may be lower from a premium perspective, it may not be lower for you in regards to the whole grand scheme of things because you may be paying a lot more out of pocket. So if your health is solid and you travel or specialist access matters, switching out of Medicare Advantage plan to this open enrollment during the open enrollment period window might make sense to avoid future headaches, especially before underwriting windows close or change. They are changing this thing right now. They are wanting to privatize this Medicare system and put the onus and the cost back onto the consumer. Now, again, like I said, it may be the carrot where they'll say, oh, it looks cheaper over here. But at the end of the day, Medicare Advantage in most cases may help some, but it doesn't help all. And even though Medicare may be a little bit higher in regards to premium, I think I read something earlier that if everyone went to Medicare, it would save our government about $80 billion a year. And again, I need to find that. Now, if I find it, I'll put it into the notes of the podcast. But it saves the government $80 billion a year if everyone went to Medicare. But right now, they're overpaying in Medicare Advantage, in which again, the cost ends up going back to the consumer. So let's recap right now. We talked for the 5 things I think that are very important for retirees heading into 2026. We talked about the enhanced deduction, I think is powerful, $6,000 to $12,000 if you're 65 and older under certain income thresholds. Take advantage of the above the line car loan if you definitely get a new car. There's a benefit there, but you don't have to itemize. Maximize and stacking your standard deductions, your senior add-ons, and the enhanced deduction to shelter more income, possibly doing Roth conversions with that because they're giving you more right now in regards to higher deductions, which means that's less income that's subject to tax. And if you already deferred some of that money, maybe taking some of that right now may make sense. Planning retirement income and IRMAA exposure carefully. Premiums can climb fast. Make sure that you're getting with your financial advisor and your CPA to make sure we don't ultimately put you in a different tax bracket. And finally, reevaluating your Medicare Advantage versus original Medicare plus Medigap before the open enrollment closes. I think, quite frankly, I'm finding more and more people, my mother, for example, who's on Medicare Advantage, and I'm like, whoa, why? And again, I think it's powerful to have that conversation, even though they're older in age, possibly having to go through medically underwriting and things like that. But I think the headache that it removes, because we want to make retirement easy versus making it difficult. I would pay a little bit more to make it a little bit more easier for me versus just having a headache and saying, well, was my doctor in network? Is the hospital in network? Is there administrative staff in network? It becomes a harder thing to navigate. So thank you guys for listening to this 9 Innings podcast. I am here for you, the retiree. Today we talked about the 5 things that I would be looking for from a retiree perspective headed into 2026. If you have any questions, feel free to reach out. Go to the www.9inningspodcast.com. We love everybody. Have a happy holiday season. But again, it's important to understand what you have, what's going to happen, and what's going to happen to you tax-wise moving forward. Thank you guys for listening. Subscribe to the channel. Go and get my book, MLB to CFP, live on Apple and Amazon. You have any questions, comments, or concerns, you can email us at info@99capitalgroup.com. Send us your questions. Go to the website at www.99capitalgroup.com. Schedule your appointment. As you know, we're here to do what? Educate, empower, engage, and also entertain. Follow us on all social media channels at 99cap or at MLB to CFP. Follow us on our new Substack. Now what? Thank you guys for listening. This is for you, the retirees. If you have any questions, I have the answers for you. Please reach out. Thank you guys. Stay humble, stay safe, my friends. I'll see you again soon.